Advanced Cost Accounting Part 2, Cash Budgeting, Receivables and Payables. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email and phone number. Our Facebook page is also listed. And if you'd like similar topics, you can access Management Accounting 20. I wanted to jump over to some questions that I covered with a student on cash budgeting topics, which deals with cash ins and outs. Cash ins from sales and collecting receivables, cash outs for operating expenses, purchases, and other things. So I've got 5 or 6 questions here, and what I want to start with is the one that says Brooklyn here. It says Brooklyn makes all purchases on account subject to the following payment patterns. The fact is that Brooklyn, the company, does not pay for all their purchases on the first day that they buy them. They pay 30% in the month of purchase, 65% month following purchase, first month following, 5% second month following purchases. If we added up these percentages, we got to 100%. The period we're talking about is April, May, and June, so we list the dollar amounts purchased in those months. And like many questions with a lot of data, you have to go to the end of the last sentence to find out what's really being asked. What was the firm's budgeted payables balance on June 30th, the last day of this 3-month period? Let's jump over to Excel and see what it says. This is how I suggest you set up a template to answer this question. It says cash disbursements budget, and across the top we have April, May, June. I list the dollar amount purchases each month, and then I have a total column at the end, and that will become useful here in a few minutes. For April purchases, we have the pattern the same for April, May, and June, and we can set up cells to calculate dollar activity. For example, April purchases 200,000. 30% of the April was paid for in April. 65% of April paid in May. Notice that that cell is linked to April, the blue cell. The 65% paid in May. 5% of the April purchases highlighted in blue paid in June. So just for April, 100% of the purchases are paid for in this 3-month window. That is not the case with the other months. May purchases. Total May purchases, 160,000. 30% of the May purchases are paid for in May, the month we buy the stuff. 65% in the month following June. 2 months after May is July, which is not included in our analysis, so you can see that for this line, 2 months after, for May, 2 months after, there's no number. Purchases June, 250,000. 30% of that is paid for in June. 1 month after June, July, that 65% is not included in our analysis. 2 months after June, August, 2 months after, that 5% is not included in our analysis. And you'll see that I also sum across the bottom to get total payments, and that each of these columns is a sum all the way across. Sum formula, sum formula. So in total, we made this much in purchases for the 3 months. We made this much in payments for the 3 months. So total purchases less total payments equals accounts payable, which is the amount that we have left to pay at the end of the 3-month period, which is June 30th. Let's go to the second question on that same page, Vern's, that talks about receivables. It says Vern's makes all sales on account, which means nobody's paying cash when they buy stuff from Vern's. Subject to the following collection pattern. Before we had a payment pattern, now we have a collection pattern that you'll see on the spreadsheet in a minute. We're then given sales for all 3 months in dollars. And the question is, what is the budgeted receivables balance on the last day of the 3-month period, which happens to be December 31st. So let's go to the Verns tab on my spreadsheet. Again, you can see the setup is sort of similar. This happens to be cash receipts budgets instead of cash payments. October, November, December, I include sales for those periods in dollars. And of course, I add the sum of the 3 months, which happens to be a whole quarter here on the right. It says total sales. And again, I put these sales totals up there so I can link sales and percentages here in the middle of the chart. Okay? 20% month of sale, 70,000 times 20%, that's the amount received in October. Here is the amount of October sales received in November. Notice that it's in the November column, but it's linked in blue to the October sales. 10% October sales received in December. Again, it's linked to the blue cell. So just for October, all 100% of this October sales are collected within the 3-month period we're looking at. That is not the same for everybody for the other months, November, December. November sales, 60,000, 20% of that collected in November. 70% of the November sales collected in December. It's in the December column, but it relates to November sales. And finally, the 10% of the November sales, which happens to be January, is not part of our analysis. So there's no number collected for second month after November sales because that takes place beyond the period we're looking at. December sales, 50,000. 20% of those December sales collected in December. 1 month after December is January, not part of our analysis. 2 months after December is February, not part of our analysis. Similar formula in the totals column. We have our total sales, sum of all the sales, less collections, the sum of all the money we collected, and each of these columns is a sum. Sales less collections equals our ending receivable balance, which happens to be 46,000. So that is a cash receipts budget. Let's go on to the wolf example on the next page, which gets a little more complicated. We're just talking about January and February. And in this case, you'll see we have sales, we have purchases, we have operating expenses. Sales, dollars in, purchases and operating expenses, dollars out. What's different in this case, we're given a beginning cash balance. We're told when the sales are collected in percentages. We're told when payments are made for purchases in percentages. And then there's a wrinkle put in at the bottom of the question. It says operating expenses are paid for in the month incurred. Well, that's pretty simple. And here's the wrinkle. And include monthly depreciation charges of $2,500. Keep in mind that depreciation represents expensing of an asset with the passage of time as you use the asset. It does not relate to cash. So if operating expenses, 7,000 and 9,000, include depreciation, we have to deduct 2,500 in each month to get the correct number. Note the question at the very end. Determine the change in the cash balance during February. Now, an easy mistake to make is to compare January 1st, which is the beginning, to the end of February, but that's not what the question is asking. It's the change in cash balance just during the month of February. And it's very likely that you'll be given an answer choice that's January 1st to the end of February, which is incorrect. That's not what's being asked. So that question's a little more complicated. Let's go to the Excel and go to the wolf template. What's different in this template For one thing, it's titled Cash Receipts and Disbursements, is that we're given a beginning cash balance line, $12,000. The 4,500 you can see in the formula here is the 7,000 less the 2,500 depreciation. That's the operating expenses in cash. That's why I put less depreciation in parentheses. January purchases 30,000, 20% of that is 6,000. I didn't do it for the purchases, but I think it's always handy to put the dollar amount of sales or purchases in a cell so you can link it to the activity in the spreadsheet. For example, January sales 35,000, 40% January sales 14,000 paid in January. 60% of January sales, note that it's linked to January, collected in February. February, we collect January sales of 21,000. You'll also see operating expenses. February is the 9,000 given in the question less 2,500. We pay cash of 6,500. January purchases 40,000, 20% of that is 8,000. The rest of the February purchases happens in March, which is not part of our analysis. This I already did. This is the 80% of the January $30,000 in sales. We paid 24,000. Moving down a little bit, February sales totaling 55,000. 40% of that, 55,000 collected in February. The remaining 60% is collected in March or later. That's not part of our analysis. Now, let's look at the summation column. We have a beginning cash balance that we're given. We have the ins and outs for cash, and we get an ending cash balance in January of 15,500. So you'll notice that the cell at the bottom of the page is the summation, which is the ending balance in January 15,500. Now please note that the beginning cash balance in February is linked to the ending cash balance in January. So you carry it to the top of the page. We're going to see that in a lot of this cash analysis. Then we use the same sum column to add it all up, and we get an ending balance in February. Now, what were we being asked in the question? We were being asked for the change in cash just for February. So this cell represents the 15,500 beginning balance less the $20,000 ending. There's my change in cash for February. It is not from January 1st to the end of February, it's just February. So if I go over here, you'll see that $4,500 is highlighted as an answer choice. Let's go on to pay. Where am I headed next? Right down below it. This is cash receivables that's made a little bit more complicated, because we have collections in one column and we have the ending receivable balance in another column. Okay? So it says Drago makes all sales on account. We saw that earlier. Nothing's received in cash immediately. We have a collection pattern here. We see that it's June, July, and August sales. And here are the dollar amount of sales for those months. Here's the question. What were the budgeted collections for August? How much money did you get in the door? And what were the budgeted receivables balance as of August 31st? So it's a little bit of a different take. Let's go to the Drago example here. Cash receivables budget. Months across the top. We input the sales numbers so we can drive the percentages here in the middle. I'm just going to do 1 month June because I think by this time I'm hoping people are starting to get the hang of it. 30% June sales, $36,000. 60% June sales, $72,000. Note that it's linked to June even though it's in the July column. 10% June sales in August, 12,000. So just for June, you can see that we collect 100% of our collections, our receivables in the month, in the 3-month time period. Let me say that again. We collect 100% of the June sales in the 3-month time period. July, 30% collected in the month we sell it, 60% month following August. 2 months after July is September. That's not part of our analysis, so this 10% row has nothing in it. 30% August sales, 66,000. 1 month after August is September. 2 months afterwards is October, so you can see for these 2 rows there is no dollar amount. We sum along the bottom, sum all the months, and come up with totals. We add across the top to get total sales. We add across the bottom to get total payments, which means sales less the payments that we got, which I really should say collections, equals 170,000. Now in this case, they asked you for how much money did you collect in the 3-month period and what was the ending receivable. Let's go back to the question. You can see it's choice B. How much did you collect? How much was the ending receivables? And it's just collections in August. Let's go back to our Excel document. Collections just in August. Collections, August, 174. Ending accounts receivable balance, August 31st, 170. So here is 174 and 170, which is choice B. One more little thing down here at the bottom that I'm going to spend a minute on. Kind of an easy, quick, and dirty way to look at a required cash balance is you've got a beginning cash balance, you add receipts, you subtract disbursements to get an ending cash balance. Now in some cases, you're going to be required to maintain a minimum cash balance. Maybe it's because of a bank account, maybe it's minimum cash balance that you must maintain for some loan agreement you have, for a debt. Could be a lot of things. So what we're saying in this example is that, if I go back, sometimes you have to adjust the cash balance by borrowing or putting in more money to get up to some minimum cash balance that you're required to maintain. In this example, it's $6,000. I had a dentist client of mine who borrowed money to build out a new office, add all of his dental equipment, several $100,000, and one of the things he was required to do was to maintain a minimum cash balance and also have a CD on deposit as collateral. So that's a little added wrinkle. Let's go down to Coleman here. It says Coleman anticipates sales of these amounts in these 3 months. This has to do with inventory, a little different wrinkle. The company policy is to maintain ending inventory, finished goods, ending inventory, equal to 40% of the following month's sales. The reason being, if somebody walks in the door on the first day of the month, the first 5 days of the month, we want to make sure that we have enough inventory to cover what people want to buy before we have time to build, manufacture during that month, or go out and buy things to put on our shelf. If we're a retailer, do we have enough stuff to sell if a large percentage of our sales happens right at the beginning of the month? The question is, on the basis of this information, how many units would you plan to produce in August, which is the middle month in the question? Let's go over to the Coleman example. The question stated here at the top. So you can set up this sort of template to plan the production. So here's August. 48,000 units we're expecting to sell. But we also have to maintain 40% of the September sales in blue. We want that by the end of August, so we add on 20,400. That's what we're going to produce for the month. And then we can subtract the ending inventory from the prior month, the 19,200 that we were maintaining to cover the beginning of August sales. And if we add that all up, we get production that we need to do for August. 68,400 production less beginning inventory equals 49,200. If I go over to my Excel, there's the answer. Over to my question, there's the answer, B as in boy. Let's go to my last one, which is the most complicated. And in fact, rather than look at the question because it's so lengthy, I'm just going to go to the spreadsheet because this one happens to be the most complicated. And I'm more concerned about how you set this up than actually reading through a question. So, this is a cash receipts and disbursements. We have beginning cash balance. We have operating expenses, less depreciation here. We've already done that. Purchases, paid the month after the purchase, and then there's another wrinkle, less a 3% discount. So January purchases get paid for in February. And you can see how I multiplied it by 97% because we get a 3% discount. February purchases paid in March, you can see that I multiplied it by 97%, we get a discount. Sales in January paid on this schedule. So here's January collected in January, January collected in February, January collected in March. So just for January, we collect almost all of our sales. You can see that the percentages, though, only add up to 99%. So 1% of our sales we don't collect. We don't get that cash, maybe because clients went bankrupt and didn't pay, for example. February sales, 110, 50% in February, 30% in March, the remaining in April. You can see how that goes across. We've seen that several times. Another wrinkle, we have receivables that don't relate to these sales periods at all that we happen to collect in these months that relate to sales made before January. We also have payables that we pay down that relate to periods before January of 72,000. We pay that in January. And we get an ending cash balance. And you'll see that the ending January balance is the beginning February. We have ending cash balances here at the bottom, and we can come up with cash payments made in February. So the question is set up just like we've seen in the questions before. You can also, if you like, add the purchases across to check that figure to get total purchases. If I can scoot over just a bit. Here's total payments that you made, which sum up the ending cash balances here at the bottom. So there's several different things you can do with the chart. This is used by business all the time. I don't know of a business person who wouldn't have this sort of analysis done on a spreadsheet or maybe in a piece of software. Either one. But everybody does this sort of analysis, so it's very important that you understand how it works. You see, you can set it up simply in a spreadsheet if you like, or you can do it in some sort of packaged software. There's a lot of software programs out there that will do this for you, and you just plug in the numbers. So we had several examples. This was receipts and disbursements. The Drago example was just receivables. Coleman was planning production, August production. Brooklyn was just cash disbursements and payables. Burns was cash receipts and sales. Wolf was a little bit of both, beginning cash balances, operating expenses, purchases, sales and get to an ending cash balance. That is the end of Advanced Cost Accounting 2. You can go to our website and see a continuous classroom where we have weekly live chats and small groups on critical accounting topics. Our YouTube channel where you can find a complete list of our videos. We have live one-on-one tutoring and chat sessions you can find at our website. Here's our email address and our phone number. Thanks very much, and we'll see you next time.